good morning to everyone. My name is Priscilla Liebert Calder. I am the event coordinator here at the Rutgers-Newark Small Business Development Center. And on behalf of Dr. Tendai Ndoro, the regional director, I would like to welcome you to our webinar today on taking control of your company finances. A little bit about the SBDC for those who are not familiar with us. The SBDC stands for the Small Business Development Center. We are the premier provider of business training and technical assistance services to establish small businesses, startups, and entrepreneurs in New Jersey, particularly those in Essex County. We are one of 12 centers in the NJSBDC network, and our center is hosted by the Rutgers Business School and funded through a partnership agreement between the United States Small Business Administration, Rutgers University, and the New Jersey Business Action Center. Our mission is to help entrepreneurs and business owners start and grow successful businesses through delivering one-on-one business consulting, training, and technical assistance programs, such as those that the one that you're attending here today. For the benefit of those who are attending today's webinar, audio has been muted. And we will be taking questions via the chat or the Q&A feature here on Zoom. Please feel free to post your questions and we'll do our best to answer those questions either during or at the end of the presentation. A copy of the presentation slides along with a video recording of this webinar will be emailed out within 48 to 72 hours of the end of this presentation. We'll try to get it sooner, but please allow up to 72 hours for us to get that out to you. Okay, so it is now my pleasure to introduce to you our presenter for today, Mary Baker. Mary is the owner of Baker Tax Accounting Service. It's a tax preparation and accounting firm here in Linden, New Jersey. She's also a SBDC consultant here at the NJSBDC. So for our clients who are experiencing issues with cash flow, you have tax related questions, you need help with your bookkeeping and your financials, most of you may come across Mary as your consultant. So without further ado, I'll let Mary, tell you a little bit more about herself and get into today's presentation.
Good morning. Good morning, everyone. I hope everyone is doing great today. How are you? First, I would like to thank each and every one of you for participating in this webinar today. It will be exciting, even though we are talking about numbers, but it will be a great webinar and you will learn some key numbers that you need to know to help grow your business. I'll tell you a little bit about myself and who I am. My name is Mary Baker. I am the founder and CEO of Baker Tax and Accounting Services and Get Your Business in Order. We are a company, I have been devoted to educating business owners for over 40 years in how to reach their financial goals. I have a passion for just educating business owners on how to grow their business. I have assisted several organizations, profit, nonprofit organization, hospitals, and university out of Essex County and Union County. It is my pleasure to be with you today. And if you have any questions, feel free to ask the questions in the chat. So with that being said, let's start our day. So
Mary, we're not seeing your screen. I'm sorry. I'll share your screen.
I'm sorry, you're not seeing my screen?
Yeah, just
Okay.
share.
Okay. Am I sharing the screen? I'm sorry.
Yeah, click the share button to share your PowerPoint.
My whole screen?
Mm.
Okay, I'm sorry here. Okay, it's not sharing the screen. Okay, hold on. Let me see what's going on here.
Yeah,
All right, I'm
the
here.
share button is at the bottom there.
All righty. I apologize to everyone. It's not showing at all here. Hold on one second. I apologize. Here we go. Let's try this again. Okay.
There we go.
Can you see it now?
Yes, yes, great.
Okay. I apologize to everyone um, with sharing the screen. Okay. Okay, I'm a little new at this, so something is going on here that's not flowing properly for me here, Priscilla. It's going backwards instead of forward. Hold on.
Yeah.
Yeah, it's not. Oh, it says screen sharing has stopped.
Okay, click the share button and to
Okay.
share the PowerPoint again.
Okay, let's see what's going on here. I apologize for the delay. Um, okay, so let's try it again. Is it sharing now? Can you see it?
Yeah, we're good.
Okay, great, great. I apologize for that delay, everyone.
Just click from the beginning. Yeah,
Okay,
there we go.
okay, there we go, there we go. So today, what we're going to talk about is just getting your business in your business finances in order. And so basically today's seminar will not be your ordinary seminar. I know as business owners, a lot of people tell you, okay, you need to get your finances in order to just get things rolling in your business. It is so important that you do get your business finances in order. Just for instance, with the PPP, just was happening now in the SBA loans that's going on. I have found that a lot of businesses just did not have their paperwork in order. They didn't have their finances in order. And because they did not have their finances in order, they didn't qualify or they didn't receive all the funds they needed to keep their business going during this pandemic. So today, what I want to go over is not just about keeping your business finances in order. It's about what numbers you need to know to help your business to grow and where you need to focus on in your business as far as your dollar amounts. So cash flow, there are three financial statements that most businesses, if you're going for a bank loan, if you're going for a government grant or any of that, they ask for. And those three statements is your income statement, your balance sheet, and your cash flow statement. So today, what I think is very important, we're going to focus on your cash flow. What is cash flow? How is it important? The agenda today will be about what is cash flow, what caused cash flow problems, what is a cash flow statement. We'll go in detail. We'll also go in detail about business finance ratios that a lot of people do not discuss with small business owners. And then we'll have the question and answer sessions at the end of the seminar. The first thing we're going to talk about is knowing your finances in your business. Business finance is about managing your company's money. Your business, if you don't know your dollars, you don't know your company, I always say. Your company numbers, finance, tells the story about your business. So if you walk into a bank or if you walk into SBA and want to get a business loan, the first thing they want to know is your numbers. How important your numbers is. What's going on with it? Do you know your numbers? And you should go into these companies and organization knowing what is going on with your business, the finance. That's the first thing they ask for. That's the first thing they look at. One of the major reasons why businesses fail today is because they run out of cash. And the reason why they run out of cash is because they do not know what's going on with their numbers. Yes, we do get cash in. It seems like a great deal of money at the moment, but is that cash covering our liabilities in the company? You have to know to keep your business running smoothly, you need to have cash. And as business owners, you also need to consider long-term investments. I always say this, we business owners, you have to think of your finance differently. I always say you have to consider your personal finance and your business finance together, because if your personal finance is not in order, your business finances is not in order. So we need to think about that as business owners, long-term investment. How is my company going to grow over the years? Am I looking to purchase a building? Am I looking to make a major investment? Or is it just that I just want to run my business and always stay on top of it? So knowing your finance is an important key in running your business at all times. So what we're going to talk about is cash flow. Cash flow is the money that is moving in and out of your business. When I say money coming in and out, that's your sales. Are your sales covering your liability? Are your sales covering your expenses? Are your sales covering your employee wages? These are topics that we need to talk about. Cash is coming in for your customers or clients who are buying your product or service. That is your cash flow. It is very important. Cash going out of your business is in the form of payments of expenses and liability, employee wages, overhead costs, and those things. So it is important that you know what your cash flow is looking at year to date. I always say monthly, and even if you want to do it weekly, it's so important that you know what's going on in your business. There are several reasons why you may have cash flow. Cash flow may mean you're having cash flow problems is because you're not having a cash reserve. All businesses, you should have some type of cash reserve. And the prime example is what happened to us this year with the COVID-19. A lot of our businesses were not able to open and operate. So did we have enough cash on reserve to pay for bills and expenses that are still due? Whether or not we are closed or open or operating, there are still liabilities that we have to pay. Did we have enough cash to pay for our lease on our business? Did we have enough cash to pay the mortgage on our building? Cash reserve is very important. I recommend that we should have at least 3 to 4 months cash reserve on our business. Another issue, a major issue with cash flow problems is slow paying invoices. And so when I say slow paying invoices, these are clients that you have and they're not paying your invoices on time. Your terms of your invoice should match your cash flow of your business. Some people may have 30 days, some people may have 15 days, and sometimes people may not pay for 45 days. This can definitely cause a cash flow problem in your business because you're not receiving money in to pay your expenses. So you should always make sure the terms on your invoice or customer payments, if it's not payable at time of service, should be in a time term that will help you cover your expenses. Another cash flow problem that we really usually have is high overhead costs. And when I say high overhead costs, sometimes we get caught up in our business. Sometimes we may have expenses, say like a telephone bill, a business telephone bill, or business insurance. And so once we get it, we don't think about, okay, let me look and see if I can get these services or expenses a little bit cheaper. There are times that you just need to check, like your business insurance. It's okay before your next year premium is due to check. Call another insurance company or insurance agency to see if they can give you a policy covering the same thing for a lower amount. That's some of the things, like the telephone. Business telephone, I have a business telephone, and I just changed services because now my another provider was able to offer me the same telephone service at a lower rate. So you should sit down, go over your overhead expenses, and see if they match with your cash flow at all times. Another major issue is inventory. I see a lot of businesses that have products order excess inventory, inventory that is not moving out of your business in a timely manner to cover your overhead. You may have inventory, there may be items in your inventory stock that is not selling at all, but you're continuing to order it. Why order it if no one is purchasing it? So you need to sit down and look at your inventory and have a count. What's on hand? What's going out? What's my seller? What do I sell most of? Is this what I need to keep on keeping stock mostly? And then the things that are not selling or selling at minimum, do I just need to keep 10 of those in stock when someone asks for them or purchase them? So excess inventory is another major reason why we have cash flow problems. The next one is incorrect sales forecasting. And so when I say that sales forecasting is, we may purchase something, liability, have something that we want to purchase in our business that's of a large amount, and we don't have the cash to pay for it, okay? Which would turn us into a negative. So just not knowing your numbers, not knowing your business finances, you are sales forecasting over the amount that you can afford. It's so important that today, I hope you all will learn that it's so important to keep up with your numbers and how important it is when you're making sales, right? Because if you say, I know I'm going to sell $1,000 worth of items, so I could go ahead and purchase this $1,000 printer, but then you only sell $500 and you already purchased the printer, that's, you're going to be in the negative, which is very, very important. The next one, which is a major issue, is employee theft. If you have a product that you have going out, do you have something in place to prevent employee theft? This is something that a lot of business do not talk about, but a lot of the major companies have a department just to control employee theft. Like I know, for instance, like we have UPS. When the employees go in, when the employees come out, they have security there just to make sure there isn't any employee theft, just to reduce the prices. Because if your employees are stealing your inventory and your items, then you're not able to sell, which will bring you into a negative number as well. And the last and the most important one is bookkeeping. I see all the time small businesses, mid-sized businesses that just doesn't have it in place. A lot of times they feel that the owner feels that they can keep up with the company, they can keep up with the accounting, they can keep up with the bookkeeping, is just so much. And so if you had a proper bookkeeping system in place, you will know your numbers. You can see what is selling, what is not selling, what are some of the things that you're spending money on that you can reduce the cost. So just not knowing your numbers can definitely cause you a huge cash flow problem. So is everyone in here? Are you understanding? Or am I moving too fast? Just let me know what's going on, because we are going to get into the numbers at the next part. So is everyone okay with what I have explained so far? Okay. Okay. Thank you. Thank you. Okay. Now, one of the major statements that a lot of people do not ask, and so when you usually go to an organization to receive funding, say if you're going for a business loan, say if you're applying for grants, if you're doing government certification, these are some of the documents that they ask. And so most of the time you always hear about profit and loss statement, you hear about a balance sheet. Very rarely, most of the organization does not ask for a cash flow statement. But the cash flow statement is actually a statement showing your actual incoming and outgoing of cash in your business over a counting period. It can be monthly, it can be quarterly, it can be yearly, and also you could do it weekly, just to know what's incoming, what's coming in your business, and what's going out of your business is actually the actual cash that the cash flow statement shows you. This way, if you know what the cash flow is showing, it gives you enough time to plan what's going on in your business. It looks at the amount, it looks at the timing of how the cash flow is coming in and how the cash is going out. So say for instance, if I have a term for my customers to pay me is 45 days, right? My cash is coming in 45 days, but my rent on my building is 30 days. So you really have to be proactive in this and knowing what to do. The cash flow statement is also great for budgeting when you would like to budget all of your bills, the business bills, even your personal bills. If you're an owner of the business, I always say, and you'll hear me say this several times, you need to consider your personal expenses as well as your business expenses to get ahead. So the cash flow statement is great for budgeting. What's going to happen over the next 3-4 months of my business? So for me, for example, I have a tax service. So the majority of my income comes in January through April in my business. That's where I would say 80% of my income comes in as a tax preparation business, right? And so for that, I need to budget for the entire year what I made in January and April. And just looking at my cash flow statement, I can tell when is my peak time, when is not my peak time, how much business I need to sell, say when it comes to July and August, in order to cover my expenses. It helps me to also plan out my business for the 8 months, the rest of the year. So just knowing what comes in, what goes out at a specific time in my business is very important. So for you, it's very important that you do use the cash flow statement to make sure you understand what's going on in your business. A lot of times, like I said, you don't hear it. Most people ask for the profit and loss statement and the balance sheet, but the cash flow statement is a benefit to you as a business owner. You should always know. I say if you have an accountant, or if you have a bookkeeper, if they can give you this information on a monthly basis, that's great. I say do it monthly so that you can plan out your next month. You can do it quarterly and yearly when you're budgeting, but I say it's better to have it on a monthly. If you have your numbers up to date, you can do it on a weekly basis, depending on your business and what do you do. You can have it on a weekly basis as well. That way you are up to date, you know what's going on in your business at all times. Okay? So are we okay so far? I cannot see the chat, but I will. If you have questions, we're going to go back. We're going to answer all of these questions. Okay?
I think someone, Mary, someone asked, can you show what a cash flow statement look like?
Yes, yes. So as we go along in the webinar, I do have an example of a cash flow statement. And then if you like, it's one in there that you will get with the package when Priscilla sends that to you. So you'll know exactly what a cash flow statement is. Thank you.
Okay.
Actually, our next sample is a sample of a cash flow statement. I don't know if anyone can see this clearly, but if you cannot, I will make sure that you get one that you can actually download as an Excel file, and then you can start using that. So just let us know, just let SBDC know if you would like to have one, and we'll make sure that you get an Excel one that you can download and send it into and that you can use. So as you're looking here, this is a monthly cash flow statement. It has here what your opening balance would be. So your opening balance will be basically the cash you currently have on hand. What do you have on hand? What do you have currently in your bank account that you can actually have access to at this immediate moment? So your opening balance will be your current cash on hand, right? Of what you have. And then as you go along, you will see a section there that has your cash, incoming cash, right? So let's be clear. This is not your profit and loss. This is your cash flow statement of what you're currently dealing with. Let's look at cash flow statement. I always say, look at cash flow statement as current. What's going on in your cash flow statement, right? So you're looking at the cash that's coming in. You have your current sales of your service and products, your access sales, which is your products. If anyone owes you money, any type of, you have out, someone owes you, debtors out there that owes you money, that's also considered cash that's coming in. And then it's any other type of income that you have coming in your business. Make sure it's not your personal income. You should not commingle those two together. It should be what income you have coming in into your business, what type of cash you have coming in. If someone owes you money or they're paying you at the current, that should all be accounting for in your cash, your incoming cash that's coming in. Okay? Now you have what's going out, your cash outgoing. If you see there is a list of purchases you're making, if you have to purchase inventory, if you have to purchase anything for resale, which we call cost of goods sold, that would be items that are going out. You have your accountant's fee, you have your advertising, marketing, Any expenses that you have for your business should be included in here. You have your bank fees, you have your interest if you have a business loan, or if you have a business credit card and there's interest being paid on that credit card, that should be included as well. You have the credit card fees. You should have all of your utilities. If it's electrical, if it's gas, if it's water, any of those fees that's outgoing, that should also be included as well. If you have, I always say, and this would be another webinar, if you're working from home and you have an office in your home and you have a dedicated section in your home, then there are some of the utilities, a percentage of the utilities in your home that you can use, that you can account for business. And then you can include that also as your outgoing cash. On your cash flow statement. You have your business telephone, you have your business, even if you have a cell phone that's dedicated to your business, you can also include that. One note on that, if you do have a cell phone that's dedicated to your business, I say your best practice is to get additional cell phone line to kind of separate that cell phone cost to your personal cost when you're using a cell phone. You have your lease, your loan payments. If you're paying any leases or if you're paying any business loans, you want to consider that. If you're paying rent or any mortgages, if you own your own building, business building, those are things that go out. You have motor vehicle expenses as a business owner. If you're a business owner and you travel to your clients, or if you use your vehicle to conduct business, that you can also include car payment, car insurance, a percentage. If you use this vehicle for personal and business, there's a percentage of that you can use for to write off as outgoing. Any repairs you have, any tolls, any gas, all of that is also monthly cash flow, outgoing cash. You also have repairs, maintenance, if you have printing, if you have any membership fees, any affiliation fees that are going out. If you're a member of, say, for instance, a Chamber of Commerce organization, something like that, you can also include those fees as your cash outgoing fees. If you have licenses, if your business is a business that require license in the state of New Jersey, that's a fee that you can use. If you have insurance, I hope everyone that owns a business that you have some type of business insurance. It's so important to have a business insurance. With everything that's going on, you definitely need business insurance. If you have taxes, are you paying estimated taxes? If you have a product or service that is sales, is that you're collecting sales tax on in the state of New Jersey, that needs to be included as outgoing cash. And if the sales tax is coming in your cash incoming, you need to add that, but it will zero itself out in cash outgoing. If you're paying wages, salaries to your employees, employer taxes, you need to also include that as well. So anything that you know that's going out, you're paying out of your business on a monthly basis, quarterly basis, or yearly basis needs to be included in this cash flow statement. If you're doing it, if it's an expense, say for instance, you have business insurance, right? And that's only payable once a year. It needs to be included in that cash flow statement for the month that is payable. And then you can also include it in your budget. And then once you have those two, the cash incoming minus the cash outgoing, you will get what your monthly cash balance is. And that dollar amount should be a positive. We always would like it to be a positive. But what I always like to say, that positive amount should always, as a business owner, if this is your only source of income, should cover your personal expenses as well if you're going to use or you're giving yourself a salary out of the business. And so with that, you should always, we hope you all should have a positive balance at the end of the month. If not, if you're a new business, if you're up and going, and if you're running and it's a negative, you just need to go back and see what's coming out of the business. Can I not pay this for this month? Is this a necessary expense that I need for this month? Do I need to have this expense for each month? So these are some of the things that you need to consider and looking at your cash flow statement. If you would like us to send you one, like I said, just make sure you put that in the chat box, and Ms. Priscilla will make sure that we get that to you as well. A sample one that you can use in Excel that you will be able to use and follow that on a monthly, weekly, and basis. So are we okay so far, everyone, with what we have? And I know sometimes dealing with numbers, it gets a lot confusing, but we'll just go back. If you have any questions, just feel free to ask any questions, okay? Thank you. So our next step, what we're going to get into is what we call ratios. And so these ratios are business ratios, depending on your business and what type of business you have. You will know, and you should keep this going. It helps you budget, it helps you plan. A lot of times I see people, they tell businesses, okay, you need to have a profit or loss, you need to have a balance sheet, but these ratios, trust me, if you have these ratios in order, you will know what your business finances look like, and you'll have a better understanding on what's going on with your business. So these are just a briefly, but I'm going to go over each one of these ratios with you. I try to put it as simple as possible so that you all have a full understanding of what it is, and then you will get a copy of this webinar so that you can go back and understand any of these ratios. So some of these are some of the major ratios that we have in the business, and then I'm going to go over them. You have the quick ratio. I apologize. You have the current ratio. You have the gross profit margin. You have the net profit margin. You have the return on assets. You have receivable turnover. You have receivable days. You have inventory days. And these are companies that have products that are sitting in inventory. And then you have the debt to equity ratios. I don't know if you ever heard of any of these ratios, but we're going to go over these ratios and how important they are and what do they mean to each one of your businesses. Some of us, we may not have them all. If you're a service business, you will not have inventory days because you don't have any stock or anything in inventory. So we will start going over this. So the first thing what I did was I broke the ratios down by what they mean. Liquidity ratio, it measures your company capacity to pay its debt as they become due. And so what that means is these are the ratios that's going to show you, will you be able to pay whatever expenses you have or whatever debt you have on a timely basis, right? So you don't make any late payments. Just in case, I don't believe in paying any extra payments for late payments on items. Why would I give someone an extra $50 when I could take that $50 and use it for something else, right? So these are just some of the ratios. Now, the liquidity ratio is just letting you know, do you have enough cash on hand to pay what you have to pay? So the first one is the quick ratio, which is basically telling us off the balance sheet. This is usually, you can get this information off the balance sheet. The quick ratio is the asset test for estimating at a glance whether your company is facing any immediate problems in paying your debt on time, right? If you have this problem, you need to go back and look at what's going on. So on the far right column, I have here the formula. These are all division. So for the first one, in order to determine your quick ratio, you're going to take your cash, and that's cash what you have on hand, not cash that you're expecting to receive. You're going to take the cash that you have on hand, right? Plus the accounts receivable. The accounts receivable is the dollar amounts that you're waiting to receive in, that you're waiting for your clients to pay you with, right? So it's the cash plus the accounts receivable, right? Divided by your accounts payable, right? And accounts payable is anything that you have to pay or that you're paying out, and any current liabilities. So when we say current liabilities, those are liabilities that are due, if you're doing this in a monthly basis, due within that month, right? You're going to take your cash on hand plus the accounts receivable and divide it over your accounts payable plus your current liabilities. And this will give you what your quick ratio is. Do you have enough cash now on hand to pay whatever debt you owe? So does everyone get that? I can't see the chat, but if it's okay, I'll move on to the next one. Okay.
There's a question, Mary. I'm so sorry.
Okay. Thank you.
How do you know, this is from Jacqueline, how do you know how much of a positive balance you should have in closing balance? Is there a number or percentage of sales so you know if you're ending with enough dollars at the end of the month?
Okay. So what you need to know is if that number at the end of the month, once you start following this cash flow statement, if you know at the end of the month that you have a positive number, that positive number should be able to cover, say, your next month. We always say have cash reserve. It should be able to cover your next month's expenses or what you have coming up, at least until you get more cash receivables in or anything that's going out. Is that kind of clear? Is that clear?
Yes, she said
Okay.
yes, thank you.
Good. Thank you. So the next ratio, and then everyone is going to get a copy of this because I know it's a lot of numbers, but believe it or not, if you follow these ratios or if you just test it in the beginning or just test it for a week or 2 weeks, or even if you don't do it yourself, have your accountant say, hey, this is what I have and I need to know these numbers. How do I get to know to keep up with these numbers on a monthly basis. I would say don't go no further than a monthly. You can have them quarterly and yearly, but if you want to be on top and if you want your business to grow and you want to function properly with no debt and paying everything on time, ask your accountant. You need this on a monthly basis, just so that you can get familiar with it and you know what's going on in your business. Okay? The next thing is your current ratio, which is usually these numbers will come off the balance sheet. The current ratio is used by banks to determine your level of if you were to resolve your business or close your business, right? Will you have enough to pay them back? The rule of thumb that you should always remember is that your current ratio should be above 2, right? So what the bank doesn't tell you, when you go into a bank and they ask you for these reports, right? Most of the time it's the profit and loss statement and the balance sheet. What they are doing is taking these numbers, they're using these numbers to determine these ratios. So with the current ratio, the bank is looking at this and said, hey, if I give this business a loan, will this business, if this business decide to go out of business, will this business be able to pay back our money, our loan dollar amount? And so the bank doesn't tell you that, but these are some of the reasons why they ask you for these financial statements. Okay? So with the current ratio, and this may be a long thing, but it's okay. You're going to take the cash on hand. When we say cash, that means the cash you currently have on hand, available to you at this moment in your bank account, is the cash on hand, plus your accounts receivable. So the accounts receivable is any outstanding that any of your clients should be sending you, outstanding payments that you should be receiving, would be your accounts receivable. It would be your inventory. And if you own a product or whatever, inventory, it would be that, because your inventory is worth, it's like cash, it's worth something, right? It's just like you're having cash. And then any other assets that you may have, right? The bank looks at all of this, and this is considered what you own as a business. You're going to divide that number over accounts payable, and accounts payable is what you currently have to pay out, what expenses you have that you need to pay out, right? And any other current liabilities you may have. What other liability that you may have out there? Do I have a business loan that I still have to pay? What other liabilities do I have in my business? Now, I want everyone to keep in mind, we're only talking about your business numbers. We're not talking about your personal numbers. You shouldn't be including your personal debt or any of that stuff on any of these reports, on any of these ratios. This is only what the business. And I know some of you may be saying, hey, but I got a business loan and the loan is in my name, right? But it was a loan to run your business. Because most of the time, when you get a business loan, the bank usually say, I'm giving it to the business, but we really have to use your credit, right? Or collateral. So I want you to keep in mind, these numbers are just based on your business, not what you owe personal. So even if you went to the bank and got a business loan and a business loan and it's in your name, but it was for the business, it's still a business loan, okay? So the current ratio, I'm going to go over this again, is the cash plus the accounts receivable plus inventory and any other current assets that you may have, divided over your accounts payable, what you have to pay out, and any current liabilities. Okay? Do everyone have that? Do you have that? Okay. So the next ratio we have is the profitability ratio. And so that ratio measures your company's ability to generate a return on its resources. And so when we say that, we're saying that, is my company able to get a return on my products and service that I offer, right? Will I make a profit off of my products and service that I offer? So the first thing you want to look at, which is great, is your gross profit sales. So your gross, and that usually shows up on your income statement. And usually the banks pull that off of your income statement. The gross profit sales is the total sales minus cost of goods sold. The cost of goods sold are items that you purchase for resale, right? The gross margin is gross profit as a percentage of your total sales, right? So, with that being said, your gross profit margin is your gross profit divided by your total sales. Trust me, each and every one of you, if you go into the bank with these numbers and have these ratios, and I tell you, if you're walking into a bank or organization or anywhere that you presenting your business and you want to sell your business, not sell it to someone, but just say you're marketing your business. If you walk into in your business with these ratios that I'm giving you today, and you walk into a bank, you will really impress them because they will know you know your numbers, right? They'll know you're serious about your business, and they'll know that you keep up with your business, you know what's going on in your business, and they're willing to give you money because they know you have control of your business. So it's very important that you take these ratios. If you go in there, because believe it or not, majority of the businesses, when they go in there for a business loan or government grant, they do not walk in there with these numbers. So if you walk in there, you're ahead of the game, you know what's going on, and it'll look great to you. So the gross profit margin is your gross profit divided by your total sales. And remember, if you don't do your numbers yourself, your accountant should be able to give you these numbers. Or your bookkeeper. So if you don't have an accountant and you have a bookkeeper, you should be able to get the numbers from the bookkeeper as well. Okay? The next ratio is your net profit margin, right? These numbers usually come off of the income statement. The net profit rate is net profit as a percentage of sales. So that's your net profit divided by sales. And so the difference between your gross profit and your net profit is that your gross profit is all of your sales before you pay out any of your expenses, right? So your gross profit is all of your total sales before you pay out any of your expenses. That's your gross profit. Your net profit is your gross sales, right? Any sales you have, your gross profit minus your expenses. That is your net profit, right? Your net profit is your gross profit minus any expenses will give you your net profit. And you're going to take that number, your net profit, and divide it by your total sales. Okay? That will give you your net profit margin. Okay? which is great to have because you want to know, okay, what my business look like before I have expenses, what it looks like if it's profitable after I pay my expenses. That gives you that number, okay? The next ratio is return on assets, right? This shows up on the income statement and the balance sheet, these numbers. This is your key bottom line. This here tells you whether or not your company is actually generating profit from your level of products and service access that you have, right? This is so important to know because with the return on assets, you want to know what I actually have. Is it really making me a profit? If not, then maybe I need to eliminate something. Maybe I need to increase something. My cost, my sales, my cost on my service or product. The return on asset ratio is your net profit. Remember, your net profit is your gross profit minus your expenses will give you your net profit. And then your average assets. What do you have? Your average assets will be, you take all of your assets and then you just average it out. Okay, so let's just say you add up all your assets. You have 100 assets, right? And out of that 100 assets, it's 5 pieces. So to get your average asset, you're going to take the 100 divided by 5, and it'll give you your average assets. Okay? So that's very important. These numbers, these ratios here will tell you whether or not what you have, what you're selling, your products or your service is making any profit for you. You need to know this because you may be selling a product, even though you're trying to keep up with what the average cost would be for a consumer on your product out there, but you may be selling it too low, you know? You may be saying, okay, I'm sorry, you may be selling it too low. You may need to increase your cost on that. So these are numbers that you need to look at that will make sense. Even if you have a service business, you need to say, okay, my time, if I'm spending, I apologize, if I'm spending 2 hours with a client and they're paying me $50, is that worth my time? Or do I need to go up on my fee per hour, right? Or how much time I'm spending on this project or offering this service. So these are things that you need to be able to look at on a basis. And if you have a service business, because I know sometimes a lot of the service business say, well, do I need these numbers? Yes, you do need these numbers. Because you need to know how many sales you're going to make, excuse me, to make this profitable for you. Does that make sense to everyone? Okay. The next one, we're almost done. We're almost done. Is the efficiency ratio. This tells you how well you're managing your company assets and your inventory. Now, excuse me, 1 second. Now, I apologize. So now on this here, this ratio let you know, are you using your assets and your inventory and your time in an efficient way, right? Is it really bringing you what you need? And then these numbers also let you know, okay, is this working or is this not working for me? The first one is your receivable turnover. All of these here in this efficiency ratio usually shows up. You can see these numbers. You can get these numbers off of your balance sheet. The receivable turnover, this tells you how quickly your company is able to collect on your accounts receivable. Remember I said earlier, I apologize. Um, remember I said earlier, it's so important how you set your payment terms for your clients. Um, are you receiving on your cash flow? Are you receiving your accounts receivable, your money due in a timely basis, just to cover your expenses in your business, right? So that you don't have to pay your debt late. The receivable turnover is your sales, right? How much sales you did, your gross sales, right? Divided by your average receivable. The way you get to your average receivable is you're going to add up the numbers of your receivable and divide that by the number of receivables will get you your average receivable. This is let you know whether or not how quickly you're getting your money back in your business. If there's outstanding balances, how quick, what's the average of how am I receiving my payments from my clients, right? The next one is your receivable day. This ratio measures the average time your company required to collect accounts receivable during a specific time span, right? So this is giving you, if I want to know in a month or 3 months on a quarterly basis, what is the average time that someone pays me, right? What is the average when my clients pay me? You're going to take your average receivable. Remember, your average receivable is the number of receivables divided by how many receivables times 365 days, which is year, divided over your sales. And this will give you a clear picture on how many days it is taking your company to collect on your receivables. And you need to look at this number because you want to know, am I being paid on a timely basis? Am I not being paid on a timely basis? Do I need to change the terms on how much? Instead of 30 days, I may need to go to 20 days or maybe need to go to 15 days in order to make sure my company is running effectively, okay? And the next one is your inventory turnover. Now, if you have inventory, these are companies that you have products that you're selling some type of product. You want to know how quickly your inventory is being turned over, right? It can be, you can do this, you can streamline this one down to the point of each individual item that you have in inventory. If you like to know, like, okay, is this my best seller? Is this not selling as fast as, is this not moving out of the warehouse on a timely basis? So the inventory turnover ratio is the cost of goods sold. Remember, the cost of goods sold is the items that you purchase to resell, for resale, right? Divided by the average inventory. So you want to do this, and I recommend anybody that has products that you're selling, that you may, if you have the time or if you have someone that could do it, they can give you, you want to know this, I would recommend on each individual item you have in your inventory, because you want to know, is this sitting on the shelf too long? Or do I, or I cannot keep enough on the shelf, right? So that way it'll give you time, like, okay, this is when I need to reorder this. When this goes down to this specific amount, this is when I need to reorder this in stock. So this number will help you with how fast your inventory is turning over. And then the last one you have is your inventory days. This tells you the average number of days in a specific period. I always like to do monthly. I just think quarterly is great, but I like monthly between purchase of the product and the sale of the product, which is really, really a great thing to have, right? So I say monthly because you would have control over it and you know what's going on. So if there is a problem, if you need to reorder, if you need to fix something, you can do it within that month. But if you bring it all the way out to quarterly, 3 months down the road, will I be able to fix this error or did it triple because I waited quarterly, right? So I would recommend that you take control of this on a monthly basis. The inventory days is your average inventory time 365 days over the course of goods sold, right? This will give you the period between which you purchased the item as the business owner and when that item was sold. You need to know that if you're selling a product because excuse me, it just tells you that did I sell this product? Do I need to store this on the shelf? Can I use other shelf space or do I need to order enough to keep up with demand? These will help you run your business efficiently. Okay?
Mary,
Oh,
Lisa asks, what is average inventory?
so average inventory, anything, so we'll put it this way, anything that says average, right? And I know all people, we all not number people, right? So anytime something say average, you're going to take how much of that you have, right? So say for instance, I don't have, say for instance, you have 300 items on 300 items, right? On inventory, correct? And you divide it by 5, but they come in 5 lots. It's 60%. It's 60. So your average is 60. So anything, if it says average receivable, if it says average inventory, you're going to take the numbers of those items, right? You're going to add that number together. Say I have 2,000 items in inventory, right? But they come in a lot of 60. You divide that on any number, and that would give you the average of that item. That makes sense? So let's say, for instance, receivable, right? I'm trying to use a simple number. I have $200 of receivable. We could go up to more, 2 million. I have $200 of receivable, right? And I have, out of that $200, I have 3 customers that owes me, that makes up that $200, right? So your average receivable will be 67%. That makes sense? Is that clear to anyone?
I haven't seen an answer yet.
Okay.
Okay, she said yes.
Okay, good. So anything that says average, if it's receivables, inventory, anything that says average, you're going to take that whole amount, divide it by it, and that would give you the average number. Okay? Okay. All right, we're moving along here. Okay. And so the last ratio we have is the financial leverage ratio. I call it debt to equity ratio. This ratio is important to lenders. As I said before, it shows how much debt you're in your company compared to how much equity you have. When the banks or any organization, when you apply for a loan, anything like that, they do not tell you that they're using these ratios, right? I would say too, Sometimes if you're going in there and you're applying for something, you may want to ask them, like, what ratio are you looking at? It just make you go in there, you look like you're smart, you're great, you're on top of it, you know it. What ratio do I need to have to qualify for this loan, to qualify to be in this program? And so this just will tell you if your debt ratio is higher than your equity, right? It just gives them a debt to equity ratio. So I'll use example, and I get this all the time. When someone, and I know this is not business, but say like when someone's purchasing a home, right? When people, or no, I could use it as a business loan. So you go into the bank, you know your credit is excellent, you in the sevens, you know, you got excellent credit, you don't, you pay everything on time, everything is great. And then when you go into the bank and apply for a loan, they say you don't qualify. And the first thing most people say that has a good credit and everything, the first thing they say, but my credit is good. I pay my bills on time. Why are you not qualifying me? The main reason is because your debt is higher than your equity. And so for them, that's telling them you have more debt than you have equity. So how can you put on another debt when you can't pay, you don't have enough money to pay your current debt? So that is so important. They look at that. The banks don't tell you that, but that's the number one thing that the banks look at. That's the number one thing I tell everybody. That's the number one thing mortgage companies look at. You can have excellent credit, but if your debt is higher than your equity, they're not going to qualify you for a loan. They will not qualify you for a loan. So it's great to always know that, what your debt ratio is. Okay? So we want some answering and question sessions. It's 11:14. I just want to make sure, do you know your business numbers? Everyone that's on here, if you do not know your business numbers, I think this is the first step in helping you to understand what your business is about. So it's 11:15. I'm open for questions. Anything anyone has, any specific questions that you may have that I can answer for you. Remember, you will all get a copy of this printout of this webinar and the information and the ratios on there. So does anyone have questions that I can answer? Does everyone know their numbers? So just a general question. Does everyone knows their numbers?
We have a question from someone that asks, can cash flow statements be needed monthly for a cannabis business?
Definitely. It definitely can be. You definitely want to use it for a business of that type because you have a product, right? And because you have a product, you want to know what's coming in, what's going out. I do know, like in some of the cannabis, you have different, I don't know, what do you call it? Different types, right? I'll say different types. I don't know the proper word. But you want to know definitely what's moving. What's moving in your business, right? So all businesses, you should know what the cash flow statement is because you want to know, do I have enough money to pay employee? What's going on? How am I operating? What I will say though, as a business owner, I always, and I think I said this about 4 times today, you don't include your personal on this cash flow statement, but what I would like for all of you to keep in mind, when you're thinking of a budget, cash flow, things like that, being that you are business owners and if this is your only source of income, make sure you have a number of what your personal expenses is, right? You want to make sure you have that number. And because you know automatically at the top of your head, I need to make at least enough to cover my personal expenses, right? Because I always say, if my personal household expenses is not paid for, I'm not going to be able to focus on the business. So always, if that's a starting ground for you, always keep that as a starting place of, okay, I know I need to make this just to cover my rent, my mortgage, my personal side. That makes sense to everyone? Okay.
Okay, she said, thank you so much. Yeah,
Well,
okay. I see there's a few questions here about a copy of the webinar. Like I did say earlier, a copy will be emailed out within 48 to 72 hours. So everyone will be receiving the PowerPoint presentation and a copy of the recording of today's webinar,
yes,
along with the template, the cash flow template.
yes. So we would definitely send you a cash flow template. I will use one that is Excel so that you could just download that template and use that going forward.
Do we have any more questions? We'll give it about a minute if you have to type.
Okay.
Sade, can you explain? You said, can you touch base on text on desktop? What does that mean? If you can clarify your question. Or I'm not sure if that was meant for us.
Okay.
Okay. On desktop for bookkeeping. Okay, can you touch base on desktop for the bookkeeping? Am I to assume, Sade, you're saying if she can talk about software for bookkeeping? Is that what you're, yes, that's what Mary, she's asking.
Okay.
You know, can you talk a little bit about software that you can use for bookkeeping that perhaps they can get access to that cash flow statement?
Sure. So the one that I use and the software that I recommend is QuickBooks. QuickBooks have different versions. I recommend QuickBooks Online. And the reason why I recommend QuickBooks Online is because you will be able to pull your information from anywhere you're at, even if you're in a meeting, on your cell phone, you just have access to it at all times. QuickBooks is the most popular bookkeeping. They have one for self-employed. They have one for any level of business that you are in. They have one for service-based business. They have one for all types of businesses. And so with QuickBooks also, I recommend it because if you have an accountant or someone you need to send your data to, you could just easily click a key, create a report, and send it off. A professional, nice report that you can send or you can print out. So I recommend QuickBooks. They have QuickBooks that you can use it on your cell phone. They even have a feature. They started with a new feature in QuickBooks where you can actually, if you have a receipt, right? If you have a receipt and say like you're having a business lunch and you have that receipt, instead of remembering to save that receipt, you can actually take a picture of that receipt on your cell phone and it'll automatically be inputted into QuickBooks for you. You can get that detail with QuickBooks. So I recommend QuickBooks because majority of the accountants or bookkeepers use QuickBooks, and it's right online. They charge a minimum fee is like $20 a month, depending on the size and level and users of your business. But the very basic one is like $20 a month. Yet you can use. And it's just so handy. And then everyone uses. And QuickBooks integrates with any software you have. If you have a POS system, any of those types of systems, all of those generally integrate into QuickBooks. So I recommend, I'm not a seller for QuickBooks or anything like that, but I think it's the most easiest and best software nowadays to use because it's available to you anywhere when you're out there.
Okay.
Okay.
And I would like to also add to that, Sade, the Rutgers-Newark SBDC, we have a QuickBooks workshop that actually goes through some of the, the ratios that Mary discussed, and it kind of walks you through using QuickBooks and how to run the reports, so you have a better understanding of what's going on in your business. A lot of what Mary talked about today is covered on that all day workshop. I think there's one coming up soon. If it's not in October, it's in November. You can definitely look into signing up for that webinar. And the good thing about it is, as an SBDC client, there are sometimes discounts for that software once you participate in that class. As Mary said, sometimes you need to get your overhead down. So if you can get something a little cheaper, that will be good. But feel free to visit our website and see what that course is about. It's about bookkeeping and QuickBooks, and be sure to sign up for the next one.
Right. Good, good.
Do we have any more questions?
Thank you. So I can be contacted. If anyone needs to contact me, you can contact me through the Rutgers, New Jersey SBDC. The information is on the screen. If you need a one-on-one consultation, please contact the office and we can arrange to have one-on-one with you. And if once I send you the spreadsheet, if you have any questions, feel free also to contact us, SBDC.
Great. You're welcome, Lisa. You're welcome, Lola. Mary, thank you very much for a very informative webinar. And as Mary just said, yes, please feel free to reach out to us. The SBDC offers no cost to you. Consulting in matters such as bookkeeping, marketing, anything that you can think of. If you have further questions about your cash flow statement, your financial, your numbers, your ratios, feel free to reach out and schedule a one-on-one with Mary or one of our counselors. It's an important time for you to know what your numbers look like. There's a lot of funding being available. It's great for us to position our businesses so that we can take advantage of what's out there and what's to come. So we really need to really, as she says, get our businesses in order, know what those numbers are, and prepare ourselves to take advantage of any, whether it's grants, loans, or any programs that perhaps may come along in the future. One of those is the PPP, and coming up in the next 30 minutes, it will be another webinar that covers, what you need to have in place for the PPP once you have it, how to put your bookkeeping and document your expenses. We all don't know if there's going to be another round of that, or if it's going to come down the line again. And if it is, it's good to know what you need to have in place and how you should spend and structure your finances to take advantage of it, so that you don't have, I think, a perfect the most important part of the PPP is there's a part of it that's forgiven, and there are specific rules that you have to follow to make sure you don't have to pay a lot of that money back. So even if you have not received the PPP, I encourage you to just spend an hour with us and take a look at that webinar that's coming up at 12 o'clock. So without further ado, I will be closing out today's webinar. We hope to see you in the next one at 12, or any of our upcoming webinars in the next couple of weeks. Thank you for participating, and have a good day.
Thank you. Thank you.
Bye-bye.